Okay, great. Sanjay, do you want to say a few words and start your presentation?
Wonderful. Yes, absolutely. Thank you so much. And yes, really great to see so many people here taking interest in this topic. Thank you ever so much. I'm really pleased to do that. I think Ellen and I spoke about this very briefly in advance, and I think our plan is to speak only very briefly, because there's nothing more painful than being spoken at great length via Zoom. So we'll do that like very briefly, and then maybe have a few breakout rooms and then bring everyone back together again. Why don't I just start by just making a few points, and maybe an easy way to do this would be to just refer back to the forum posts, because that means that you'll have something to refer to after the talk. So do I have the right to share my screen on this? It looks like I do. Hurrah, it's cunning work on the part of Meg. Well done, thank you very much. So hopefully now you can see that the forum posts that I've got up here, and there are two posts that I recently put up on the EA forum. The first one is the $100 trillion opportunity post, and that's perhaps a bit more focused on the EA community in particular. So I'll just go through that one very quickly first. It claims that ESG investing is currently not high impact, but it could be. I don't want to spend too much time on the language here, but I'm talking about ESG, responsible, sustainable investing, roughly synonymously with each other. And so I've applied the ITN framework here. So I argue that it's big. So the $100 trillion comes from the UN Principles for Responsible Investment. And to get a sense of scale here, like $100 trillion, it sounds like a lot, and it is a lot. Like, depends on how you measure the total invested assets, but it won't be in the quadrillions, it'll be in the hundreds of trillions. So it's a material proportion of overall invested assets. There's an interesting claim about tractability here. So I would argue that it's probably a pretty good place for tractability. And I say that because there is a huge amount of ESG investment, responsible investment, massively taking off recently. So that means we're actually at a great time to make things happen in this space, because the space is got enough traction that you can make things happen, but it's still young enough that it can be shaped. And then in terms of neglectedness, I think I'm pretty positive on this as well. So there are some nuances about exactly how you define neglectedness. I'm pretty much following the Owen Cotton Barrett definitions, using the mathematics that he employed. And under that approach, the number of people in finance, under my interpretation of that approach, the number of people in finance isn't necessarily the right thing to look at, but rather how many of them are actually trying to achieve impact-motivated ESG. And arguably, if those people are trying to do this, what I call impact inward approach to ESG investing, i.e., what are the risks that my company is exposed to because of ESG factors, and not what risks is this company causing because of whatever, the environment, social issues, or whatever, then we're missing a big part of the story. And this distinction between impacts inwards and impacts outwards means that a lot of people are focusing on or trying to do what you might arguably call the wrong thing. So there's an interesting thing here about the fact that the EA community has not really given a lot of attention to this area up until now. And so the reason for that, I argue, is that there's been focus on a normal individual. And if you've got that perspective, then the conclusion, actually, it's pretty hard to have a lot of impact as an impact investor. Pretty reasonable conclusion, in my view. But this whole piece on the EA forum and the adjacent one is about a different question. It's about, can we collectively, working together, improve the whole system so that the whole system has more impact? And so that perhaps is why the EA community has neglected it, despite the fact that it's potentially really, really impactful. So that's a quick canter through that first post, and I'll maybe try to, if I can, I've done something weird with my Zoom settings. How do I change it? Okay, good. I'll very quickly refer to the content of the second one as well, but I've already taken several minutes and I don't want to speak for too long, especially when we have superstars like Ellen on the call. So in this other post, which is quite a bit longer, I've alluded to this distinction between inwards impact and outwards impacts, which I've just spoken about a moment ago, and fiduciary duty. I won't spend too much time on that. It's just the whole legal regulatory system is exacerbating this problem of too much focus on inwards impacts, not enough focus on outwards impacts. I introduce this term universal ownership. It also links to a post by Ellen on top of universal ownership, which is obviously a great read. If you can have a look at that as well. What I'll do, actually, I won't say much more about universal ownership. If we have Ellen here, I'll leave that to her. A really important thing is, and this is part of the tractability point, that this article is entitled ESG investing isn't high impact, the current state of the world, but it could be. And so this section just says there is a way that this world could actually have this world of ESG investing could actually have real world impacts on the wider world. And so as an example of that, if we have really good, strong engagement in terms of equities, that could be effective, and a few other things as well. And then one other thing, and I think this is particularly important for those of us from an EA background, we are used to the idea that choice of cause areas is important. And we are used to thinking really hard about that stuff. Now, if you encounter people in the world of ESG investing and responsible investing, and you ask them, what are the most important topics or cause areas to focus on when it comes to ESG and responsible investing, it's really common to hear the answer, climate change is the most important thing. Why? Well, it's just obvious. No more further thought needed. And I think there's a real opportunity to get the thinking about this to be much more rigorous and to open out that world to other high impact cause areas. Another thing that I think is useful to allude to is section 6, possibly useful enough that maybe I shouldn't have hidden it halfway down this post, this rather long post. But I set out here a bunch of different areas that you could work in if you decided that you did want to work in this space. So individual asset owners, you can't work there. That's just normal people like you and me, passing their money to pension funds, life insurers, things like that. They in turn get asset managers. This could be BlackRock or Vanguard or AllianceBernstein or whoever, those people to manage the funds, and then these funds are in companies or other issuers of securities. And essentially, I suggest in here that success, what does that look like? It's when the asset managers, the BlackRocks, the Vanguards, those people have become really impactful in the way that they engage with firms and issuers. And then I somewhat boldly, given that I've arguably not had enough time to properly review this, but I've been courageous enough to put a star rating on each of these in terms of how impactful they are. And I suggest that in here is you can have some impact that's not the best place to work for example, a life insurer, but a consulting firm that's exposed to lots of them could be really good. And then these guys over here could have loads of leverage because, for example, if you're an asset manager, you'll probably lean pretty heavily on what ESG rating agencies like MSCI and Sustainalytics have to say. And some of these other things could be potentially really high impact as well. So I probably don't have time to go into each of those, but you can see here, this is what the table looks like. And you can see in there the different ratings that I have, rightly or wrongly, given to those topics. And then there are some appendices here in which I spent a huge amount of time thinking about how the tools in your toolkit. So, if you are an investor, you could use asset allocation. Do I divest or invest? You could also engage. So I, as somebody who owns this stock, I can say to the management, hey, look, don't do that bad thing, please do this good thing. And of course, you can't do both of those two things at the same time. So there's an important question about which is more valuable, and that is explored a bit over here. And I mean, lots of this leans very heavily on Ellen's work. So I've counted through that very quickly, but that was deliberate. Let me stop there, and I guess we're handing over to Ellen.
Hello. Thanks, Sanjay. So I'll maybe just iron over a couple things that Sanjay has said, just because I feel like they're pretty critical to return to. And then I'll maybe add a couple of my favorite targets and explain universal ownership and the reason that I view divestment as being compatible with it now, although I've changed my mind about that in the last year. So first, just to really reiterate, it's not that ESG or responsible investment is like going in the right direction, just slowly or something like that. It is wholly misdirected, which is, I think, why some tough thinking in the form of the EA community could play a role in changing things. ESG is, as Sanjay said, concerned with the impact on the companies and portfolios. So they're a risk abatement tool, and they're pretty good at that. They may protect your portfolio a bit from the climate change that they'll do nothing about, for example, but they're not even aimed at or focused on whether or not that company or fund has an impact on the real world, which is the real issue that we would all want to tackle. If you want to actually have an impact and actually solve some of these huge systemic risks that we face, there's no good just stock picking in the stock market. That's really truly rearranging deck chairs on the Titanic. It does not matter whose shares you own or don't own. That's a symbolic matter because that's the secondary market. It's all about what kind of new capital is flowing to companies. So that's how you have an impact with your actual money. I'll come back to this in a second. I think that there are ways to have an effect across other dimensions, but if you're just talking about the impact of cash, it's just useless to be looking at the stock market and picking which shares you buy. So if that's your attitude, then you have to kind of flip things around. So responsible investment is all about stock picking and public equity. As Sanjay has said, you'll want to do a lot of engagement in public equity because that's how you can actually affect the behavior of companies. And then you'll want to do the equivalent of stock picking in other asset classes where new money is actually flowing to things. I'm going to keep returning to climate change as my kind of example, but there are a lot of other things that you can use this on. So antimicrobial resistance is something we've been working on lately, for example. So if you're flipping things around like this and you're having an impact by asset allocation in other asset classes and through engagement in public equity, then it's really helpful to think about the targets as Sanjay has done. But I just want to add two more, and one of which I'm surprised that he didn't include because I know that he thinks about it a lot, and that's insurance. But the other one is banks. If you look at new money that's flowing into fossil fuels, about 90% of it comes from debt. So that's largely bank loans and quite a bit in the way of bonds or fixed income as well. So that's all flowing through banks. So, and that includes, in fact, initial public offerings and a lot of other kind of underwriting activities for the capital markets. So if you look at the full spectrum of, again, new capital that's currently flowing into fossil fuels, just as, again, as an example, you end up with a picture in which banks are your primary target. They're the ones controlling or directly contributing this money to these new uses. And if you're like me, you're trying to look for the leverage points. In my view right now, the leverage points are trying to stop new infrastructure from being built and stop new development or exploration and development of new fossil fuel resources, because that's where the vast majority of emissions come from. So if you have that kind of leverage points and impact analysis lens, which I know you all do because you're EAs, then that really helps narrow down your focus. And because if you look at who are these big banks that are providing the vast majority of the capital, there are actually only a few dozen of them doing this that account for the vast majority, again, of this new financing. So, if you happen to be a banker at one of the top, 40 banks in the world, you yourself have a big chance to do something in this area. And look, as much as I don't think that individual actions are very useful in this space, to be honest, the one useful thing you could do is actually switch banks right now. And that is actually slightly impactful directly, but also banks and asset owners like pension funds don't hear from customers about this stuff ever. Like, I talk to the people on the back end here all the time, and they never hear anything about it. If it would be a banner year for them to hear from 5 pension holders as to what the pensions policy is on any of these issues. So I do hope that actually each of you will go switch your bank and write to your pension fund. And although those are activities that will not take you very long at all, it could actually really help somebody internally in either of those institutions to increase the pressure on the decision makers. And that's one of the dynamics I think we have to think through in this whole space, is like, how can we provide the fodder for people who are inside trying to make certain things happen? Like, basically, how do we give them enough weapons to do battle? And honestly, just a very small number of people saying anything to these players would make a big difference at this stage, and it would constitute a big rise in direct communications, because people aren't aware that this is how the system works, so they don't know where to apply pressure typically. So write to your pension fund and switch banks. I think I just saw something on the, Triodos is a great bank. So I think anywhere in Europe and the UK, you can switch to Triodos. If that's useful. Finally, and sorry, this is a bit disconnected, but I'm trying to just echo certain things that Sanjay has said and fill in gaps where I feel like it's useful to have a bit more information before we get to the discussion. But I just want to describe universal ownership to you all for a moment. It's the idea that a large pension fund or sovereign wealth fund or university endowment owns a more or less representative slice of the whole economy, just because it's diversified and long-term. And if that's the way that you work, then you have to pay attention to externalities. There's basically no such thing as an externality if you're a very long-term and diversified owner of capital, because the costs from one thing, let's say Exxon and their emissions, the costs of that end up getting picked up elsewhere in your portfolio. So I guess this is just to mean that, just to say that, like, luckily there actually are some heroes in the wings here, and that's in the form of these giant boring institutions that we barely ever think about, that own the majority of capital, and certainly have power over the BlackRocks and Vanguards who deploy that capital. So those are really the kind of the nexus of capital deployment. And if they were to behave as universal owners, they would do exactly as Sanjay and I have both been saying, which is that they will typically engage in public equity in the secondary market. In the primary market, they'll be really careful as to what they own so that it doesn't contribute to huge risks like climate change or antimicrobial resistance or a bunch of other things. So that's why it's actually a very useful framework. It means that there's a very good reason for some of the biggest players in the whole economy to think this way, and we can help them to think that way if they do, that's really a bit of a game changer. As we've discussed in the past, it doesn't solve every single thing. It doesn't solve minority rights issues and other things like that that are still very important, obviously. But it can go a long way towards a whole bunch of issues, including, climate, biodiversity, inequality, including diversity issues, antimicrobial resistance, pandemics. Like, you can go through a very, very long list of things, and universal ownership could contribute meaningfully to addressing them. And then finally, just to say that I don't now view divestment as being incompatible with all of this, mainly because there's a different theory of change. So I wouldn't advise this necessarily for like a big pension fund no one knows the name of, but I'm at the University of Cambridge, and I do think it's the right call for Cambridge to have divested, because although we have a large endowment by university standards, it's pennies compared to the whole system, and we have a lot more clout than we have money. In which case, the theory of change for divestment actually kind of makes sense. The theory of change being that we don't tend to get the legislation that we need to address issues like this, and climate change, for example, is one that really does require a lot of legislation. We don't tend to legislate things that we don't view as wrong. And we're unlikely to legislate or regulate fossil fuel companies appropriately unless they are properly stigmatized. And that's what divestment does. So it actually gets at quite a systemic issue, which is support for fossil fuels and or their lobbying power. This is a way of countering all of that and building support for the legislative / regulatory change that we actually need. So anyway, I think there is a justification for using that tactic for any institution that has a lot of kind of clout or legitimacy in society. And just to say, you can deploy that in a whole bunch. You should do both anyway. Like, just because you divest, you own every other company in your portfolio. So you should be engaging regardless of whether you divest. Anyway, I hope that's useful. I haven't really been looking at the chat because it's hard to do two things at once, but I think the rest of the time we're going to just have a discussion so we can answer some of these questions. Does that sound right?
And so, Meg and Eleanor, in terms of our way forward here, is it useful to have a bit of Q&A and then go into breakout groups, or were we just going to go straight into breakout rooms?
I think having a bit of Q&A would be great. I think people would love if Ellen could address some of the questions in the chat if possible. And if anyone wants to add some more questions for Ellen or Sanjay in the chat, that'd be great.
Okay, should we just go through?
Sure.
Okay, I'm trying to scroll up without scrolling too far. Okay, question, what is the reason you only focus on people working in finance to influence BlackRock, etc., and not people who work in corporates themselves? Look, if the problem is there are too many, I mean, there are thousands upon thousands of listed companies in the world, and they're actually, if you took the top 100 asset owners in the world, you could deploy much of this without any trouble. So it's really just about leverage points. Sanjay might have a different answer from mine, but it's just...
There might be specific companies where it could be valuable. So if you were to take an investor relations role, for example, in Exxon, say, then, I still think it's probably more valuable to be on the side that has the power, like the side that has the money and is distributing it, are the people who can make the demands. But if you're on the receiving end of those demands, I mean, first, the demands have to be made, right? I mean, we have to change the finance systems that they're making proper demands. But once that happens, then having somebody on the investor relations side who's hearing those and feeding those back to management within Exxon, there could be some scope for that person to help to highlight the fact that, these demands are there. But I'd sort of see that as a, probably less valuable, I'd say, than actually being on the side where the money is and using that to make powerful demands.
And just to say, if you're inside a company, you aren't going to be able to make transformative change without huge pressure from your investors anyway. So it's like, might as well go to that initial leverage point. So I just want to caution, someone has said individuals can help by demanding ESG funds in their 401k or retirement options. I would argue that is not enough. You have to ask them whether they're applying the same filter to the bond part of your portfolio just to start with. But I mean, ESG is crap. Like it just is. Sorry to put it that way, but it's useless unless it's applied very rigorously to the primary market part of your portfolio, and that almost never happens. Which is actually part of the other reason that I'm sort of sympathetic to divestment calls, because if you say divest everything and across all asset classes, it's hard to get out of that. But otherwise, yeah, ESG is just not enough. Ask about your fixed income portfolio though, and make sure that that doesn't have any company that you wouldn't want your money flowing towards. Okay, we've got another one here. I do actually invest in EFT. ESG, in my opinion, it is a good choice. I really encourage to really have a good look on Morningstar platform. I think you're probably talking about Morningstar platform too. Also, McDonald's is present in some EFT, ESG. I do agree about Rebecca. Outside US, it's more on the individual choice. Okay, so I'm sorry to push back, but it doesn't matter. Like McDonald's is not helped or hurt by your investing in an ESG EFT. It is all about, like, unless you have a bond EFT, which is pretty rare, you're not helping or hurting any of those funds. What you could do is see what the voting and engagement record is for the company that ultimately controls that for your ETF. But other than that, it's really not going to do anything. I'm really sorry. It feels like I'm delivering bad news. Sanjay, do you have anything to add to that?
No, I agree. I think it sort of emphasizes why the focus here is on people working in the sector, because we need people who are passionate about making change to work in the sector, so that what Ellen's just said is no longer true a few years in the future.
Yes, and by the way, just a couple things to look for if you do get nerdy about this and look into your pension fund, for example. What you want to see is that they vote against the re-election of directors on the engagement side. Like, that's how you know whether they're really ahead of the pack or not, because that's much more effective than voting on shareholder resolutions, which they might try to talk to you about. They should be voting against like hundreds of directors at the very least, if they're really serious about this. And then again, do look at the names in the bond portfolio if you have one, because that's where it actually matters. Okay, so then there's a question. I thought corporates do SEO all of the time, so secondary market prices are still important. So I've reviewed the evidence on this. It's really, really hard to shift share prices at all, but even if you do, it's hard to trace that back to any change in company behavior. You'd have to change the share prices quite considerably, and that's unlikely on the basis of purely ethical considerations. Anything to add, Sanjay?
It might just be worth expanding the SEO in case people don't know about that.
So I'm assuming that's a share offering, right? Share, Dean, if you want to speak up. I don't usually use the term SEO myself, but I'm assuming that's
it's a secondary equity offering.
Yeah, So issuing of new shares.
I thought doesn't matter. I always thought it kind of does. I don't know. It's
well,
like
if
you own the shares and you're voting against people, it still feels like you're helping the corporate, the whole existence more than if you just don't own the shares at all. But you know more about this than I do.
Look, sorry, go.
I think there is something analogous about if we look at the world of debt versus equity. So Dean's point about, if you've issued whatever it is, equity in this case, and then you're issuing again, then this whole divestment stuff will matter. That's much more the case in the world of debt. Like, debt by its nature, like equities are perpetual, like, they exist by definition forever. Debt is defined almost always to have a term on it and to come to an end after whatever it is, 5 years or 10 years or whatever. So I think it sort of varies a little bit. Like, there's probably quite a lot of companies that don't actually issue equity very much, don't do equity raises very often.
In fact, most don't now, honestly. You're more likely to see share buybacks now. So, yeah.
But in the world of debt, I mean, it definitely does. It is the case that, you know, you issue debt, you are expecting to be back at the market in a few years' time, refinancing that debt and probably having more issues in the meantime. You're probably going to the debt markets all the time. So, so yes, that sort of secondary crisis is
in pure economic theory, like if the equity price kind of determines the extent to which the company is expanding their operations, right? Because if their equity price is higher relative to their assets, that means that investors want to see the corporation expand their operations. Then if the market cap is less than the assets, that generally means, like in economic theory, that the company should be contracting, right? So it seems like,
yes, but
even if you're not directly funding it, you're signaling what will end up happening in the debt market.
But you're describing why it's impossible pretty much for anything to happen due to ethical concerns. Like those are things that are driven by the market. It is, and I can put a link in the chat if useful, because I've reviewed all of the papers on this. You're not going to see a shift, a meaningful shift, because of even the largest sovereign wealth fund in the world, which is over $1 trillion itself. When it divests, there is a small hit to the share price of the company involved on the day of the announcement, not the day that they actually sell the shares. It can be before or after. It's really the market seems to think that there is a logical price for something, and that's not going to be affected by people's ethical preferences, sadly.
Yeah, I mean, I
and
agree.
again, with the companies,
policy is the only thing that ultimately matters. But I'm just not at all convinced that like the fixed income somehow matters more than the equity.
Well, so there has been already a small effect on the cost of capital on the debt side. And that is just because, you know, these companies are coming to the market all the time. So the companies that we're talking about, they are not issuing new shares. Like that's not a thing that they're doing. They are, if anything, buying back shares and then issuing a lot of debt. And because they have to do that frequently enough, it is starting to affect their cost of capital already. They're starting to get banks reluctant to extend quite as much, and especially not on the same terms. And I actually expect that to increase quite a bit, because most people who divested until recently weren't thinking about their bond portfolio. So that's the effect that we're seeing, just based on kind of social opprobrium and a bit of divestment. But I actually expect to see much more of it.
Yeah, I think I'm sure that's probably true in the real world, but like on a theoretical model, it shouldn't make any difference.
So I want to try and cut into that, if I may, just to make sure we get through the other questions, because we have quite a few. Sorry about that, Dean, so I didn't want to be rude there. When we donate, this is a question from Rebecca, we technically don't expect to earn anything in return. I imagine many people would treat investments similarly. I'm investing to do good versus donating. But for those who are expecting to make a return, do you have any perspective on the risks of switching from, say, a total market investment to an ESG investment? And so one point to make is our focus here is absolutely on the massive pool of investments from people who are wanting to make a return. The people who say, I'm really focused on doing good with my money and I'm not fussed about whether I get a return, that is a tiny, tiny drop in the ocean. So we're focused on the big pool of money here. And yeah, I'd say universal ownership is a fascinating angle that enables us to be more pushy on the impacts outwards and actually have an impact, even within the paradigm of I'm an investor who just wants to make a return. I'm sure Ellen can say more on that, but given we've got so many questions, I think maybe let's press on. The way I think of it is ESG is a term relating to investing with larger societal, etc. considerations. CSR is the same coin on the company side. How to do business with societal and CSR is quite common among large companies. Agreed. Thank you, Rachel. Doesn't encouraging one portfolio company to do something to help the rest of your book fall afoul of antitrust laws?
Sorry, can I just note something, which is that usually CSR is crap too. These things are usually good for marginal, like recycling programs or something like that.
Yes, agreed.
Sorry.
The question about antitrust laws.
So I can cover that if useful.
Please,
So
yeah.
investors collaborate all the time on shareholder engagements. That is like a normal thing to do. There's certain things that they have to be careful about in order to not run afoul of acting in concert rules, and that's stricter in some countries than others. But there are international coalitions working on something every day. So it's just, you have to be careful, but you can do it safely and legally.
Christian's asked an interesting question about, if you're a junior professional, how could you have leverage within your organization? And I mean, I think, speaking as my journey of being junior and then having been more senior, I pretty much agree with that. I think it is actually quite difficult to have a lot of leverage when you're junior. And I think the reality is you will probably, have some influence. Like there are probably, you'll have the capacity as somebody who's quite junior to, raise questions about things and make sure that certain perspectives and voices and things are heard. But it's going to be pretty hard for you as a junior banker or actuary or whatever to really shift the needle substantially. But you can point people towards other people who have got more influence, and that could be a way of having leverage.
Also, just to note, this field is exploding. So one can start out quite junior and end up being quite senior in a ridiculously short period of time.
Nice. Yeah, good point.
It's probably much faster. Like if you're looking at almost anything else where you need seniority to actually have an impact, this would be a faster route up the chain than in almost any other field. Like they're playing musical chairs now among the people who lead the major ESG shops in the big funds, and they're just like desperate for new blood. It's a crazy time to be in the industry. So you can rise pretty fast. I wouldn't see it as a 10-year project necessarily if you're really skilled.
Question from Kerry. You seem to have both focused more on public equities. Do you believe traditional asset management has more of the potential to create an impact versus alternative asset management like private equity and growth equity? So one point to make is definitely not just focus on public equities. I think both of us would probably say that there's a massive under focus on debt, which could be hugely important. And that's particularly the case because if you're issuing equities, then you've got much more public disclosure requirements. Whereas at the moment of issuing debt, who do you talk to? Well, you talk to an investment bank, and quite a lot of it's behind closed doors. So if you're doing something dodgy, like tobacco or being a fossil fuel company or something like that, debt suddenly becomes a whole lot more attractive. So there's loads of, and Ellen's got some really great charts in some of her papers about just how heavily focused for fossil fuels, how heavily focused it is on debt. And so that means that if we can take the attention more on debt, there's like a massive opportunity there. But I think Kerry's question was also about what about alternative asset management, things like private equity and so on. And I mean, yeah, I don't know if I haven't discussed this with Ellen, but my answer to that would be I'm just going for the biggest stuff, and that's the reason for focusing on that, to my mind.
There's a good reason though for choosing pretty much any part of the chain as long as you have the right lens. So you could be in venture capital and that could be very high impact because that's how companies grow in the first place. Private equity is kind of like the next stage in development. And then once, the child is all grown up, then they list on the stock market. And at the IPO stage actually is another huge leverage point, I would argue. And then the debt side obviously is huge too. But I think as long as you have this approach, like an impact approach, then any part of that would be very useful.
So I think we want to try and rush through some of these questions a little bit to make sure that we've got time. So I'm sorry if I'm going to skip past some of them. Great question from Alex about any effective NGO initiative and campaigns. My organisation, SoGive, I think I would very much like us to do some reviews on charities like Share Action, for example, and see if they have done something like that. I don't have a rigorous answer there, but we're in conversation with them. Maybe they are going to be really good. The Emerging Markets Investors Alliance is a charity that would like to have lots of EA people involved. So maybe they'll be very high impact. I've not done a proper assessment of that. Rachel asks, are we asking too much of ESG? I would say, with using things like universal ownership and the fact that there actually are things we can do that will really have an impact, that combination of things says to me, I don't think we are asking too much of ESG. I think great things can happen. Somebody's mentioned that unlike publicly traded securities, seed funding, angel investing VCs could be really impactful. Agreed with that. A whole bunch of really great further comments here. I think we probably need to, despite the fact that they're great questions, pause at this point and just allow people to have a few minutes in breakout rooms so that they can discuss this in smaller groups. So I guess, I don't know if Meg's is ready for that.
Yes.
And in terms of a conversation prompt, I mean, what I don't want to do is to have a highly artificial one where you feel you have to answer the questions that we've set. I think what really matters is just like talk about it in your groups. But if I was to set a question to prompt that, the question might be, what is now holding you back from going to work on this topic? And I know there are some people here who don't have a finance background. So for those who don't have a finance background, advising somebody who is in finance to work on this topic. And you can discuss whether you're unconvinced or you feel like, your career capital doesn't allow for it or whatever. So that's, and interpret it as broadly as you like whatever you feel is a good, useful conversation. Meg, are you ready to put people in breakout rooms?
Yes, absolutely. So I'm going to put everyone in a breakout room. You'll probably have about 6 or 7 people with you, and yeah, just have a chat about what you think about what Sanjay just said, and I'll get everyone back in maybe 5 to 10 minutes or so. Great. See you then. Hey everyone, welcome back to the main session. I hope you had a good chat with everyone in your breakout rooms. We had a really good discussion as well, and I think I just want to say thank you again to Ellen and Sanjay for starting out this conversation on ESG investing. I think there's a long way to go, but I'm really happy that we started the conversation, and hopefully there'll be more input in the forum and in other spaces for EA in the future. And I also wanted to plug EA Finance. So if anyone works in finance is interested in connecting with other people in finance, please send me a message at meg@eafinance.org or have a look at our website at eafinance.org. We usually have meetups with people who are interested in finance, and hopefully we might be able to continue the conversation on ESG and impact investing in the future. So yes, thank you everyone for coming, and hopefully see you again soon. Feel free to get in touch with me if you have any questions, and I can maybe relay some things onto Ellen and Sanjay as well. So great, thank you guys so much, and look forward to seeing you in the future. See you guys.
Thanks, Meg.